So let's look at the different time frames. So basically, market profile, one of its advantages, it helps you see the different time frames in the market. So if we go to an area of consolidation, right? So we see the market kind of coming up, and then it takes a break, it consolidates, and then it moves down, right? So if you're like a little bit confused as why some markets tend to trade with not a whole lot of volume, with not a whole lot of vigor, and all of a sudden the next day it makes a big decision and it turns around, it chops, and then it goes the opposite direction. So basically the markets, there's different traders involved. So there's like scalpers. They may only be interested in move like that might only last for 5 or 10 minutes. And then there's different time frames. So if you're like a day trader, you come to the market and you're flat, and when the end of the day comes, you're flat as well, right? So, and then there's like longer time frame traders. So like, say if you're swing trading, you might only be in the market for say 3 days to a week, and then longer time frame traders, like say if you're working for a hedge fund, or even a bank, like they might hold positions for a couple months or even up to a couple years. So basically, it's like really the market's going to do what it wants, right? So you don't see these market participants. Like sometimes if you look at the order books and the depth of market, like you'll be able to see some of it, but there's also people sitting on the sidelines. So basically, you're not going to see them until they enter, okay? And they may or may not be aggressive. So if you see a couple days when the market is in a range and you don't really understand why the market went a certain way, right? It's because, well, in a quiet market, you're if you do use indicators, that's when the indicators generally work well, as when you're in a quiet market, right? Because basically, if someone were to enter and they take you out, it's because they don't care about your indicator, so they run right over you, right? So say if a swing trader, right, that works for a bank, so say he enters, right, and you see the advantage that he would have, right? So if he took this here, so the selling tail, see the series of Ks. So as the market was coming up, right, you can see the last couple of days of consolidation, right? We had a reason to come up, right? So these couple H's, right? So we opened here, and then we seeked some buyers. So we found some buyers, and then later on in the day, the market made several decisions to continue to the upside, only to reverse. Now, if you were to look left on different time frames, you would most likely find that this would be, say, a monthly high, a monthly low, right? These references are not necessarily in the mind of a scalper, right? So you got to understand that it's like as a trader, it's not all about you, right? So other traders are there, and when they enter, they do certain things, right? So you can see the effect, right? So yes, it is confusing if you're trading here all the time, but if that's your focus, well, and you're good at it, we'll continue doing that, right? So, but to be truly successful, you have to be able to adapt, right? So when you see these moves, well, okay, and you see other players entering the market, that's their time frame, right? And that it comes down to like, okay, if you were to say take a call from somebody and say you're watching the news or listen to your coworker, well, they're not necessarily in your time frame, right? No, they have alternative motives for doing what they do, right? Whether they're your buddy and they think they have your best interest, but in reality, you could be just as easily right, and you are more familiar with your time frame, right? As opposed to watching, say, a business channel that they have a motive in the first place somebody is paying them for whatever reason, right? Because traders, they buy and sell for every little reason, right? So, but here we don't have to be concerned about the news so much and the economics behind the whole mechanics of the market. We are looking at market generated information, as they say, and a lot of traders, they see information in the past and they act on it, right? So it's, say if you were trading in this day, right, and you see this selling tail, right? So a lot of traders are still caught up in a couple days price action, and they're not looking at what's actually happening in the present time. So, and then ultimately it costs them a lot of money, because if you see evidence of heavy selling coming into the market right now, would you buy, really? Right? So like if you're looking at a bar chart, that's one of the disadvantages, because it doesn't truly represent the time aspect. So the thing about market profile is that when you see volatility, it basically gives you an idea as to what references are most likely to get other time frames interested. So like if you're trading in the middle of the range in a tight day, like if the market doesn't have volatility that day, would the banks really be interested? Well, probably not, right? But you see, if you see price poking up, well, okay, maybe it's coming above a certain high or certain low, maybe overnight high, overnight low, right? Whereas like if you're doing a scalper, like you'd be interested in the Fibonacci of 50%, right, of the day, right? That's not something that the bank might be interested in, but like when you look at these charts, you'll eventually get a feel for who is entering the market, who is working together, who is not working together, when one time frame is only working, when multiple time frames are only working, and you'll see how the imbalance or the balance plays into things. So if there's opportunity, you'll see opportunity. You'll see different levels of risk, different levels of opportunity, and that comes out in how the market is or is not symmetrical, right? So like a symmetrical day, like this day here, that's generally a little bit symmetrical, right? But you can see, okay, the day here, well, that's obviously not symmetrical, right? There's great imbalances here, and those imbalances are because the market dipped into a certain area, got other market participants interested, right, making it move, right? So then they get that, as they say, better price, and then they, other participants or themselves, they could close their orders and they could reverse their position, So you can see this like all over the chart. You can see areas of consolidation, and then you can start to see very obvious signs of buying or selling.